The Radical. Fundamental principles of freedom, rational self-interest, and individual rights. This is the Yaron Brook Show.
All right, everybody, welcome to Yaron Brook Show on this Wednesday evening. Second show today. We are going to be talking about private equity, and I also owe some reviews. So we're going to do Puss in Boots and Silence. Sound of Silence, and we're going to do one other song, Shazbot's song, something about liking his teacher, right? We'll do that as well. So, where did I had that? Anyway, so we will cover all of those. Hot for Teacher by Van Halen. So we'll do that as well. But yeah, so we're gonna talk about private equity. Anyway, after years and years and years of producing content for YouTube, they have finally decided to take one of my videos down for violating community standards, something or other. Now look, I love YouTube. YouTube makes this possible. YouTube is amazing. And not only it allows me to communicate with you, it allows us to have a chat, it allows me to monetize all of that through Super Chat, through membership, and of course its algorithm lets the world know of these videos. And even though I don't have a huge following, whatever I do have it's great. I mean, this is amazing, and YouTube is truly amazing. But these people are nuts. Guess what video they took down? All right, I'm gonna give you just a few minutes for the chat to guess what video was taken down for violating community standards. I don't swear on the show. I have a pretty balanced view of stuff. I am pretty radical, but on stuff nobody really cares. Like I'm pro free markets. Nobody cares about that. Doesn't offend anybody. I'm want separation of state from education. Nobody really cares. I mean, separation of state from science. Nobody cares. Yeah, maybe I say stuff on climate change that they don't like. Maybe a trans issue. I don't know, but something about climate change. Daniel said no, not about climate change. I missed a few lately. Trans thing. No, it wasn't a trans thing. Fenton Hopper says, was it a coronavirus one? Not only was it a coronavirus one, not only was it a COVID one, it was the interview I did with Amish Adolja. And the complaint is that we weren't consistent with, what is being suggested in terms of vaccines. I appealed, and they still rejected it. They said, no, you violated community standards. My interview with Amish Adolja. Now, this is the same Amish Adolja who YouTube has asked to produce videos for them on COVID and on all this stuff. So, anyway, Amish has appealed to them. Unfortunately, I appealed before I contacted Amish, so they turned me down. Amish has appealed to them. I wouldn't be surprised if the video comes back and they put it back on. They've already apologized to him. Just nutty. Now, they have every right to do it. They can randomly pick one of my videos and ban it. Their their community standards and their terms of service are written in vague enough manner that it gives them the right. And since I choose to use YouTube in spite of the vagueness of their terms of service, it is what it is. But it is pretty stupid. I can say that. It is pretty ridiculous. Right? Here I am defending vaccines vigorously on the show, I get accused of being anti-vax or some form or somehow or some way, or I don't know. It's just ridiculous. I can't imagine what we said. Maybe we were skeptical about giving vaccines to kids or to. I don't know. It's one strike, two strikes, and you're in trouble. So I hope they reinstate this one, because you got to believe that sometime in the next 10 years they're gonna come after me for some other videos, and maybe past ones, maybe future ones, who knows. But RFK is up there with everything, and me not good, Amish not good. But RFK has videos all over the place. So they could take my channel away. That would be really, really bad for me. I mean, they'd still be within their rights to do it, but it is pretty absolutely unequivocally ridiculous. All right. I thought I'd share that piece of news with you. It is kind of fun to think about the implications of that. If it's something really controversial, all right. Let's see. What standard was involved? Catherine says something to do with COVID and vaccines. I have no idea. They don't give you more details than that, right? They don't give you more details than that. Yeah, the episode is still up as a podcast because, as far as I know, my podcast app does not delete them and does not monitor community standards or whatever the hell that is. Right. All right. I should call it, Daniel says I should call the show again and call it the Reasonable Yaron Brook Show. Well, maybe I should call it the Yaron Brook Show for the community, or community appropriate Yaron Brook Show. Maybe we should have a version of the Yaron Brook Show which is community appropriate. And in that one, I'd ban all the people on the chat who misbehave. All right, so I got a few questions from Remo, who's not here, I think, who couldn't make the show live today, on private equity, particularly relating to some comments that Michael Milken made with regard to private equity. And then I've just noticed in the last few days, months, years, a general negative attitude towards private equity. I saw a video by one of these leftist YouTube channels that, in spite of the fact that it was filled with lies and misrepresentations about private equity, did not take it off, because when it comes to lying about finance, when it comes to lying about financiers, when it comes to lying about economics, go for it, people. No problem. Community standards do not apply. You can lie as much as you want. You can vilify people as much as you want if they're in finance. Go for it. No problem. Just don't say anything outside of some narrow band that somebody in YouTube has decided is the community standard for COVID-19. So anyway, I saw this video where they're making fun of private equity and describing it as evil and just the lies and the misrepresentations and the blatant stupidity of it. And I thought I should do a video about this. Now, I thought of like taking their video and commenting on it, but their video is like 20 minutes long, and I have comments on everything they say. Everything they say is wrong. So it seemed like it would be a lot. And it does seem like what really is required at this point, given the audience, that we basically need a kind of Econ 101 on private equity. What is it? How does it work? What's its function? Is it good? Is it bad? Is it ugly? What is actually going on here, and why is everybody so upset? Well, we know why they're upset, because private equity is successful. right? Because private equity is profitable. Because private equity actually, they don't ask for your opinion about what they should be doing. So that's what we'll do today. We're going to go over the basics of private equity, why it's probably in a little bit of trouble right now, why Michael Milken said that they don't have the right capital structure right now, but why it's been successful in the past, what is it good for? All right, so let's start with that. Basically, private equity is investment capital that is invested in companies that are private, or that takes company private, that makes them private. I.e., this is not investment in public companies. It's not invested in the stock market. It's not invested in companies where you can trade the security. You're investing in a company that is owned by a small group of individuals, of people. And sometimes it's the private equity fund that owns the company. So let's say, here are some scenarios, right? You've got a middle-sized family business. The father who ran the business is retiring. The sons may be involved in the business, but they just don't have maybe the skill, the talent of the father, or maybe and they basically want to sell the business, and they want to be able to cash out of it. And one option is to sell to one of their competitors, to sell to another company that does something similar to what they're doing, and just take the cash and walk away. And that's called a strategic merger, a strategic sale. You're selling your company to a strategic investor, somebody who is basically in the same business as you are. They want to grow, and they buy you, right? Another option might be, let's say, it might be that you sell your company to a private equity investor. Now, private equity investors are typically organized as limited partnerships. They are typically organized, they raise capital from pension plans, insurance companies, high net worth individuals, family offices. Typically I cannot invest in a private equity fund. A private equity fund, you have to have $5 million of investable securities. You have to be wealthy, right? And then, so it's for what the SEC considers knowledgeable investors, what the SEC considers investors that basically know what they're doing. That the SEC doesn't have to monitor what's going on too much, because these are sophisticated, knowledgeable investors. So they raise the capital from these investors, then they have a pool. Maybe it's $1 billion, maybe it's $500 million, maybe it's $20 billion. Could be $20 billion. And then they might come and they might buy your family business. And they might cut a deal with you where they buy your family business and keep you on as a manager. Let's say your son, you'd like to still manage the company, but you need capital, and you'd like your other brothers to be able to get out of the business and have some cash. So you might buy out some of the family. The family might remain as 49% investors, but 51% now they've cashed out, and they have the father can go and retire, and the other kids can who are not involved in the business can buy a nice house and so on. The hedge fund puts some money into the buys out the 51%. It allows the other son to still have 49, so he's vested, he's interested, he's still running the company. And basically now they split, right, the profits. And the private equity fund makes money as long as the company is profitable. Now, one of the ways in which private equities companies do this, and one of the ways in which, in a sense, they finance this, and this has been the case since the 1980s, it's through something called a leverage buyout, right? And in a leverage buyout, what happens is that they buy the business, but then they mortgage the assets. They basically take a huge loan from the bank on the assets. So let's say they paid $100 million for the company. Now, they take a loan on the assets. They mortgage the assets for, let's say, $80 million, which then can be either used by the company to grow, or it can be returned to investors as, in a sense, some kind of profit, right? And the books of the company now is only worth $20 million because it has $100 million, which is what was paid for, minus the $80 million of debt. It's worth $20 million. So that's called the leverage buyout. And of course, that is particularly hated because the assumption here, of course, is that bankers are stupid. Bankers would give the $80 million to this company, and then the investors would kind of, they've got a lot of their money back. They need a few years of profitability, and then the company can go to hell. They don't care. Which is stupid on so many levels. One is, of course, the bankers want to get their $80 million back, and the bankers also want to get interest payments on that money. The private equity fund is going to work with these bankers again, over and over and over again, in many, many deals. If they behave stupidly and irrationally in ways that causes the bankers to lose money, or causes the company to default, and then the bankers have to go through a whole process of liquidating the assets, which no banker likes doing. It's a hassle and they might lose money. The private equity is unlikely to get financing from that banker, and bankers talk to one another, so you better treat your banker well if you want to do business in that world. So why do they take on so much leverage? Why do they take on so much leverage? Why a lot of private equity transactions? Why are a lot of these kind of private deals called leverage buyouts, where there's a lot of debt in it? Well, let's say you're buying a family business. You're buying from somebody a family business, and you've got let's say even that one of the sons, one of the family members, is to stay on and run the company. But in the past, they've kind of run it like a family business, a little lazily, a little slowly, not too concerned about really maximizing profits, a little too insider. You want to get this guy, you want to get this family member, or if you've hired a new CEO, you want to get this guy really motivated, really focused on making money. Well, what you do in that case is by taking on all this leverage, you're basically making him sweat. Every month he has to make an interest payment. He better make enough cash to make the interest payment. Above and beyond the cash that he makes on the interest payment, he better make some profit because he benefits from the profit. He owns some of the company. He has a share in it. So you've really, really focused the mind. Suddenly corporate jets get sold. Vacation homes that might be on the business get sold. People travel more economically. Suddenly they start penny pinching because they know they have to make an interest payment every month. They have to have the cash flow so that the banks don't default on the debt. One of the beauties of leverage buyouts, one of the beauties of having a lot of debt, and you know this from probably your personal life, is you have a lot of debt, it focuses the mind. How do I make enough money to pay off the debt? How do I make sure to cut expenses, do the things necessary to pay off my credit cards, to pay off my mortgage, to do the things I need to do, or to pay the interest, make sure I pay the interest, because otherwise, God, my life is going to be upside down. Well, this at the corporate level is a way to do the same thing. Focus the mind of the manager on making sure he's maximizing long-term cash flow so he can make not only interest payments today, tomorrow, but over the next 5-10 years as this debt matures. Leverage also allows you to gain a very high rate of return on your investment. Again, you can tell from what's the most leverage asset you guys have? Well, some of you at least have used a mortgage to buy your home. I'm a big advocate of buying a home with a mortgage. And I'm also a big advocate of corporate debt. And one reason for both of them is they're both tax deductible. The interest is tax deductible. Isn't that interesting that the government incentivizes businesses to take on a lot of debt? Because they make interest payments tax deductible. If you have excess cash and you give out a dividend to shareholders, that's taxable. It's taxable at the corporate level, and it's taxable at the individual level. Interest payments are not taxable at the corporate level. So I might as well take on as much debt as I can. And then when I make an investment, it's leveraged, and I get high returns. So let's take the mortgage example. Let's say you buy a home in California, a shack really in California, for $1 million, right? That's all a shack, and that's all $1 million will get you in California. And you put down $200,000, and you've got $800,000 mortgage. If the value of that house goes to $2 million, which is not crazy, right? Could take 5 years, could take 3 years, could take 10 years. But if the value of the house goes to $2 million, you have turned a $200,000 investment, because that's all you put up, and you got $1 million profit. That's pretty good. You made 5x on your money, 5 times your money, sometimes in 5 years. On the other hand, if you had put down an entire $1 million and bought the house cash only, and the value of the home went to $2 million, you would have still done well. You would have doubled your money. But what's better, 5x your money or double your money? Well, 5x is much better. So leverage blows up your return. It makes your returns, if they're positive, much higher, much higher. Because you're only putting a small down payment. Who's taking the risk that the price of the house goes down? Well, you are some of it, and the bank is sharing in that risk. So you get all the upside, and you're sharing with the bank on the downside. It's a pretty good deal. And a leverage buyout, debt on a corporate balance sheet is the same way. If the company does phenomenally well, a small investment, because the rest is debt that doesn't go up in value, the rest is debt, your equity stake, the small amount of investment you make, can go up dramatically. So this is why it's done. Now, notice that if your house price goes down, how much is the most you can lose? Well, the $200,000 you put in. The rest, it's the banks. So if you get a housing crisis and prices go down 30% to $700,000 in this case, a lot of people would walk away from the home. They've lost their $200,000. They've lost their entire investment. It's gone to zero. Whereas if you have $1 million in there, you're bearing the entire loss. So mortgages are a good thing. 30-year fixed rate at a low interest rates. Get as much as you can. And if real estate prices go down, it's not good. You lose your money, but you lose a lot less than if you put cash down. And if prices go up, you get all the benefits. And your interest payments on the mortgage are tax deductible. Exactly the same thing happens on a leverage buyout. And it's why companies do it. If the government wanted to reduce the amount of debt companies take on, they would make the interest not deductible, just like the government could make your mortgage rate not deductible, which is what they should do, right? But they have now promised everybody a home, and everybody has the opportunity of a home, and so on and so forth, and they're dedicated to your mortgage, so they're not going to take the interest deductibility of mortgages away. So private equity is a way for private investors, not through the stock market, to invest in businesses. Sometimes they're small businesses who couldn't go on the stock market. Sometimes they're very big businesses. Let's say there's a big company. I don't know, let's call it Twitter. that you think is just badly run and could be run a lot better and could be made a lot more profitable. Well, what did Elon Musk do to Twitter? X, now called X, no longer Twitter, no bird anymore. But what did he do to Twitter? He did a leverage buyout. He basically, he's not a private equity fund, but he acted like a private equity fund. He put in a little bit of his money. He took in a lot of debt, guaranteed by Twitter's assets, whatever they are, not much. A lot of banks put up a lot of money. He put up, relatively speaking, a little bit of money. And they bought Twitter. Why? Because they thought they could do a better job. They thought they could make it more profitable. You know, you could argue he thought it could be better for the world, better for society, better whatever. But at the end of the day, he thought he could make more money than Twitter does. And he certainly thought he could make enough money to pay the interest on all the debt he took. Again, whether he will be able to or not is a question. And it also, at the same time, focused the mind of people who work at Twitter. They better produce results. They better start making money, because if they can't, the banks will shut them down, take them over, sell the assets, try to recoup as much of the money as they can, and wipe Elon Musk out, if that happened. So Elon Musk did a leverage buyout of Twitter because he thought he could do a better job. Carl Icahn was a corporate raider, raised money just like a private equity team would, take over companies, make them more efficient, make them more productive. Now often, and this is what the left really hates about private equity, that means laying people off. Often, that means moving a factory to another state, sometimes, moving a factory to another country, in order to make it more profitable, more productive, and getting a return on your investment. Private equity is a means by which we take relatively inefficient, unproductive companies and turn them into efficient, productive companies. It's a mechanism by which we allow family businesses to sell out and to capitalize on all the wealth that they've created and bring in professional managers to replace them. It's a mean by which we take small businesses, grow them to medium-sized businesses, and then maybe when they're medium-sized businesses or large businesses, we take them public on the stock market. And then the private equity firm gets stock, which it can sell, and the managers and often the employees get paid out when the stock is sold. Private equity basically is a beautiful mechanism that enhances markets, that enhances our ability to extract the maximum amount of wealth out of productive activities, out of productive means. So now, one of the reasons private equity grew so big, probably over the last 20 years, is that in 2002, I think it was, Congress passed a bill called Sarbanes-Oxley, which made it very expensive for companies to go public, like issue shares on the stock market. And as a consequence of that, a lot of companies didn't want to go public. They wanted to stay private. When, like Elon Musk, he gets to make the decisions and nobody gets to question him. He doesn't have to explain it to shareholders. Maybe he has to explain it to bankers, but he doesn't have to explain it to shareholders. He just does his thing. And a lot of companies said, this shareholder stuff and the costs and the accounting and everybody looking over our shoulder and the SEC and regulators, we just want to run the business. And one way to do that is to take the company private. Private equity allows you to do that. So Michael Dell did that years ago. Dell was not doing too well. He wanted to completely restructure. He had a vision for what he wanted to do, but it was just too cumbersome and difficult as a public company. Shareholders, regulators, SEC, all of this. So he basically put up some of his own money and went to some private equity funds, 2 or 3 of them, and together they bought all the shares in the stock market, owned Dell as a private equity fund, right, as a private company, did what needed to be done, restructured, bought a bunch of companies, merged with a bunch of companies, and then, I can't remember, 5 years, 10 years later, went back into the public markets, sold shares in it, and, Dell, who was already a gazillionaire, became a gazillionaire times 5 or whatever it was. But it was a way to do another round of capital raises so Dell could grow even bigger, stronger, and sustain itself for the long term. Again, private equity is just a mechanism to do these things, these kind of restructurings, these kind of changes. Now, some of the criticisms of private equity. They go in, they break up these companies, they empty them out of all content, and they lay off all the people. They make money, everybody else loses. Well, if they make money, somebody else must have profited as well. It's not a zero-sum game. So a lot of companies are losing companies. Take other people's money. If you remember the movie, if you haven't seen the movie, you should see the movie. YN Cable, New England YN Cable, was a losing company. Every year that it continued, it was losing money, losing shareholder money, losing the owner's money. Danny DeVito comes in and pays the owners a large amount of money to buy the assets of the company. They won. All the people who used to be the owners won. They got a price that they were happy with. That's why they sold. The families who the private equity people buy the companies from are all winners because they got a price they didn't expect. The shareholders, when a company goes private, benefit because the private equity funds pay them a price that they're willing to sell at. So at the point of transaction, lots of people win. Everybody's a winner. These are win-win transactions. And then let's say you mortgage the assets. Well, the bankers think they're winning, and usually they are, otherwise they wouldn't do it, because they're going to get a nice, juicy interest rate return on on the mortgage, on the debt that they've just issued. Private equity guys, the other owners of the company, the managers win because now they have a bunch of capital to deploy in order to grow the company and make it more profitable. But let's say Danny DeVito goes in, and instead of the cheesy ending to that movie, he actually goes in and dismantles the company. He fires the employees, he sells off the assets. Everybody's a loser, right? Well, no. By doing that, he's made the economy more productive. One, he has taken out of the economy a company that was losing money, was destroying wealth. He's taken the capital that was in that company and deploying it for better uses. The fact is, those machines were better used by other companies that could make a profit, or better maybe melted down into steel to be used for some other products that could be profitable for some other companies. But in their current use, under current management, in the current company, they're not profitable, and therefore they're literally destroying wealth. Now, the employees do lose their jobs. But the reality is, because that capital is redeployed elsewhere in the economy is more productive, more jobs are being created, and those employees will find other jobs if they're willing to move, if they're willing to look for new jobs, if they're willing to maybe get retrained. And generally, wages go up, standard of living goes up, quality of life goes up. I mean, this is what happened in the 1980s. In the 1980s, the Rust Belt was shut down. Much of the Rust Belt was shut down, the Midwest. And yet, unemployment throughout the 1980s went down. Standard of living, quality of life, income went up. And the capital was redeployed from dying industries in the Midwest by private equity to thriving industries in Silicon Valley and elsewhere. So this is the healthy mechanism by which markets, reallocate capital, reallocate labor, reallocate machines, reallocate resources to their most productive use. And it what allows an economy to grow, wealth to be created, jobs to be increased. But of course, the employees will complain. Everybody will see the shut doors of factories, and they will complain. And everybody will say, oh, the economy's dying and we're losing jobs to Japan in the 1980s, to China later on. Not looking at the jobs being created, at the capital being deployed, at the wealth being created, at the production happening. All they can do is look in the back view mirror at what was and isn't, not at what is growing in front of them. Private equity cannot make money by just destroying. Private equity cannot make money if it doesn't produce value. Now, sometimes they make mistakes. They buy companies, and it turns out the companies are no good. They buy companies, and they hire managers, and it turns out the managers are no good. They buy companies in industries that they think they can grow, and it turns out the industry is actually dying. So yes, a lot of private equity companies do go bust. And private equity investors lose money. Now, they make a lot of investments, so they can afford to lose a few because they make money on the others, and overall they make money for their investors. So, nothing is foolproof. Not every investment that a private equity fund is going to work. And sometimes they go into industries where they don't know exactly what they're doing and they're squeezing something that should not be squeezed. And by squeezing it, they destroy that business and they make mistakes. Right now, there's a lot of talk about private equity in healthcare. There's a good chance, if you're in mainland US, that your specialist or your radiologist or your anesthesiologist is working for a company that is owned by a private equity fund, because over the last 10 or so years, for a variety of reasons that have to do with the way these businesses are reimbursed, there's been a lot of consolidation in healthcare, and private equity has come in and seen profit opportunities here. And I'm sure there are cases in which some private equity group came in and did not realize what they were doing and squeezed doctors and reduced healthcare quality and increased prices, and the business didn't do well. And yeah, you could hear horror stories all day. In every business, you'll hear horror stories. Now, I would argue the only reason private equity is going into healthcare is because of the way healthcare is being reimbursed. It's because you need connections with government, you need connections with insurance companies. Healthcare has become super bureaucratic because of insurance companies and the government, and as a consequence, practices have to gain scale because they have to be able to deal with all the bureaucracy and all the nonsense, and they need capital to gain scale, and that capital is provided by private equity. So private equity today sustains these healthcare businesses, but I suspect that in a truly free market in healthcare, private equity doesn't probably make sense in this industry. But we're far removed from a free market in healthcare. In the world in which we exist, with third-party payers and government, you need private equity because you need scale. You need to be able to build big businesses to limit to limit your own internal bureaucracy. So, for example, all claims are dealt together rather than each office having to deal with all the insurance claims and everything else. You want standardization. Not good for patients, but inevitable given the healthcare system we have today. But look, private equity sometimes fails. That's a reality. And when it does fail, what is blamed is the whole system, the financiers. They dare to make money. How dare they make money? They dare to make a profit while some people lose their jobs. But the fact that they make a profit is a clear indication that they're providing value. And think about it. You got a lot of very sophisticated investors that keep giving these funds money. Why do they keep giving them money? Because it turns out the private equity returns are pretty good. There are decades in which they significantly outperform public markets like the S&P 500, and where they make good money, good returns. What's interesting is private equity returns are not always correlated with the S&P 500, with public markets. So sometimes public markets will go down and private markets will go up, and you get this diversification effect. So for a lot of large investors, it makes sense to put a significant amount in private equity. They get diversification. They get high returns on average. They do quite well. So private equity is a tool for investors to gain higher returns and to increase diversification. Remo asks, what role did PE firms play? What specific measures did they take in aligning the interest of shareholders and management? So one of the big problems in finance, in corporations, in businesses, is what's called the separation of incentives between managers and shareholders. Shareholders want the stock price to go up. Managers might not. They got a cushy job. They get a nice salary. You know, driving the stock price up requires hard work. It also requires taking risk. Managers don't like risk. They might lose their job. So they have every incentive not to maximize shareholder wealth, but to maximize managerial stability, to maximize managerial income. And a lot of times the boards of directors that are supposed to supervise managers are too much in managers' pockets. They're friends of the managers, so they don't actually drive them to maximize shareholder wealth. There are a number of mechanisms by which we try to align the interests of shareholders with managers. The most obvious one is to make managers shareholders. If you make managers shareholders, if you give them stock instead of cash compensation, then they have an interest in maximizing shareholder price, which is the same in what shareholders want, and you've aligned their interests. Stock options. You remember stock options? In 1980, stock options were introduced as compensation for managers. They fell out of favor after with Dodd-Frank and after the great financial crisis, just because the left hates people making a lot of money, particularly when they own it. And those stock options, again, do the same thing. The stock option goes up when the stock goes up. It's exactly what shareholders want. Stock options are a beautiful thing. Well, what PE firms do is they basically do exactly the same thing. When they buy out a company, they always give managers equity in the company. They give them a piece. What does Nassim Taleb calls it? They give him a something, right? I forget the term. It's unbelievable. Somebody will remind me on the chat what the term is. Oh, they give him skin in the game. Skin in the game. That's it. So they all get skin in the game. Managers get shares. And more than that, most private equity funds, because they're smart, because it's their money and they want to make a lot of money, because they realize that employees need to be incentivized and have the same incentive as the management and the same incentive as the private equity fund. The best way to do that is to give employees stock. So private equity firms typically pay CEOs more and more in stock than public companies do. And private equity firms usually have all employees participate in a stock plan so that all employees are incentivized to maximize the firm value, not just to maximize their own salary, but to maximize the firm value, because their salary will go up through the stock plan if the company does well. I mean, these are beautiful things. So, Fred Harper says he has an ESOP. ESOP is an employee stock options plan. stock ownership plan. Sorry, employee stock ownership plan. And private equity funds like KKR and others specialize in providing Esops to employees, to providing stock ownership plans to employees to align the interest to make sure that everybody in the company has the same interest. What is that interest? Maximize shareholder wealth, maximize productivity, maximize profits. And not just in the short run, because you're going to maximize the value of the stock over the long run, because in the long run, the private equity fund is going to sell the company. And when they sell the company to another private equity fund, to a strategic buyer, or take it public, that's when they're going to make their big bucks. They're going to make their big bucks on selling the company. And to have the value of the company really, really high in 5 or 10 years when they're going to sell it, you better be thinking long term. You better be investing in the long term. You better be creating value over the long term. Again, private equity is a fantastic way in which we align the incentives. And again, because it's private, don't have to ask the SEC's permission. We don't have to ask other shareholders' permission. You're the boss. You own the company. You just do it. Private equity firms have a lot of flexibility in doing these kind of things. And that's why they pay managers more than in public companies. It's why they're more likely to pay employees with stock than in public companies. Because they have full control. They want to make a lot of money. They know to make a lot of money, they better make sure employees and managers are happy. So it's the exact opposite of what traditionally is thought of private equity. Now, again, are there bad apples out there? Sure. Are there circumstances which private equity make mistakes? Are there circumstances in which private equity screw up? Are there circumstances where private equity doesn't think long term, doesn't pay employees properly? Sure. That happens. But that's not the rule. That's the exception, because those private equity funds don't do well, don't survive, go out of business, disappear. Now, by the way, this all came to the forefront. I think I did some shows on this, or I did something on this. No, I didn't have a show back then. But this all came to the forefront when Mitt Romney was running for president. Because Mitt Romney was a senior partner, I think he was like the CEO, of one of the largest, most successful private equity funds in the world. I think it was Bain Capital out of Boston. And if you looked at Bain Capital, they had created enormous value for their investors. Their returns were phenomenal. In addition, they had taken small companies and made them large. They turned managers into gazillionaires. They had turned employees, made them wealthy. Yes, they, like every other company, had some mistakes where companies went bankrupt. They redeployed capital. They restructured the economy. Bain Capital is a legend in private equity, and they did an amazing job. Could Mitt Romney, when he was accused of being a greedy private equity guy, could he defend his track record? No. Could he explain what private equity did? No. I mean, of all the jobs in finance, private equity is one of the easiest to explain. We take businesses that are not doing too well, we make them more productive, where they create more wealth, where they produce more, and we make money, and everybody else around us makes money at the same time. I mean, and Mitt Romney was good at it. And Mitt Romney could not defend his own industry. He could not present a case for why it was a good thing and why he was a good guy. He could not defend capitalism. He could not defend private equity. He could not defend finance. And he lost the presidential election to a large extent because of that. Because he was just portrayed as a rich guy out of touch who spent his life breaking up companies and turning people unemployed and destroying wealth, exact opposite of the truth. Now, I was never a big fan of Mitt Romney as a politician. Certainly a fan of Mitt Romney as a business guy. He did a phenomenal job. Created much more wealth than somebody like Donald Trump ever did, or any political candidate that I know of. Remorse asks, can you elaborate further on why Milken thinks PE firms have the wrong capital structure in the current and future times? So one of the things Mike Milken says in this interview is that he's worried about private equity because they have the wrong capital structure. Now, what does he mean by that? As I said, private equity relies, in order to get their high returns, on leverage, on taking on a lot of debt. Now, that model works brilliantly if interest rates are very low. Now, private equity never paid zero, but when interest rates are zero, the debt the private equity takes on is a lot cheaper than when interest rates are at 5%, where they are today. So what's happened is that the cost of doing business for private equity has gone up dramatically because interest rates have gone up. So when they take a loan, just like when you take a mortgage today, you're going to be paying 6, 7%, 8% maybe, depending on how risky it is, right? Well, the same thing, that's a lot less affordable to you than when you could take out a loan at 3%. Your mortgage payment will be more than double. Same thing happens when you leverage a company. You might now have to pay double to take on the same amount of debt. And that by necessity will shrink the number of deals that make sense for private equity funds. So to the extent that private equity relied on debt, as interest rates go up, it has to rely less on debt because the debt becomes more and more and more expensive. And it's not clear that the companies can produce enough cash flow to justify the high levels of debt. The reason private equity grew so much over the last 15 years is because interest rates were so low. And with interest rates really, really low, they could leverage all their businesses. They could take out debt on all their businesses, which means they could invest less equity, more debt, which means they could do more deals, and they could get higher returns because of the leverage. And as long as that goes on, that's fine. But right now, when some of these companies have to refinance their debt at much higher interest rates, will these companies be able to service the debt, pay the interest? How many of these private equity funds will find themselves owning businesses that can't pay off their debt, that ultimately go bankrupt? This is kind of the model for how we get a recession, is that these companies start going bankrupt. So the fact that private equity relies on debt and has become more and more reliant on debt as interest rates approach zero means that they're not going to be able to do as many deals as they once did, and not the same kind of deals as they once did in a higher interest rate environment. So private equity will shrink. Some companies will go bankrupt, not the private equity, but the companies that they own, because they can't pay off the debt. These higher interest rates, to the extent that they last, are going to reshape the economy. There's just no alternative but for them to reshape the economy. All right, that's enough on private equity. All right, let's see. We've got some super chat questions. Not a lot, actually, and not a lot of money raised. So I'm just reminding you, these evening shows we have to raise $650. So we're about $500 short of that. So we're gonna need some big bucks. Please consider supporting the show with a sticker, or asking a question, or if any of you are up to it and can do it and it's worth your while, doing something for $100, $200, so we can chip away at this big number that we're still in the hole for with regard to Super Chat. All right, I promised a few reviews, so I'm going to do a few reviews. We've got a couple of song reviews, and we've got one movie review. So let me start with a movie review. The movie review is, oh, by the way, I hope you enjoyed the private equity stuff. I hope you learned something from it, benefited somewhat. It's hard for me to tell. I know there are a lot fewer viewers than if I was talking about something in politics, or something in the culture, or something crazy, or some left versus right, or some woke thing. People are less interested in these finance issues, I know, but hopefully some of you find value in them. All right, so let's do the movie review. The movie review is the latest Puss in Boots movie. It is Puss in Boots: The Last Wish, which I've watched now twice because I watched it once and forgot to do the review, and then I couldn't remember enough about it. I had to watch it again to remind myself of what it's about and so on. So this is a character, Puss in Boots, and they're going to be spoilers. Puss in Boots is this character who's heroic and full of self-esteem and self-confidence, running around the world, saving the damsel, killing monsters, helping people, just and always with a smile on his face and a song and he's just having a great time, and is funny and entertaining and is admired by people and a hero, a real hero. And then he encounters death. And he says to death, I'm not afraid of you. I'm a cat. I have 9 lives. So what? If I die now, I'll just come back. And this says, you do have 9 lives. Or actually, you had 9 lives. You've already died 8 times, Puss in Boots. This is it. This is your final life. And Puss in Boots goes, oh no. And he completely loses it. And he suddenly realizes he's mortal. And he completely loses it. He can't be heroic anymore. He can't fight death. Death is just too scary. He's completely frantic. He's completely nuts. And he goes off. He goes off basically to this place where cats are just lying around and doing nothing. And he loses all that energy and vibrancy and love of life and heroism and, cockiness and arrogance that he had before that made him entertaining, and he becomes this boring house cat among hundreds of other house cats being treated. At the same time, there is this quest going on. The different characters are part of a quest to find this fallen star. This fallen star allows you to make one wish, anything. You can wish for anything. And, we've got Goldilocks and the 3 Bears chasing this, and we've got the kid who puts the thumb in the pie, I forget his name, who's now an adult and really, really evil. He's chasing the wish. They're all chasing the wish, and Puss in Boots finds out about this, and he says, okay, I can go and I can ask to get more lives. I can start over. I can get 9 lives. And then I can go back to the way I was. I can be this heroic, amazing figure. Right? So the rest of the movie is this quest to find this star so that Puss in Boots can make a wish. He's also teamed up with this other cat, female cat, played by Salma Hayek, who wants to go wish so she can find basically a soulmate, find somebody she can trust. We'll get to that again. Goldilocks wants to get a family, a human family, rather than a family of bears. And the kid with the thumb, he just wants power. He just wants power. Anyway, off they go on this pursuit. It's an adventure. And part of what we learn during this pursuit is that the female cat and Puss in Boots were romantically involved in the past. He stood her up at the wedding because he was afraid. So it turns out that he was really a coward all along. He was afraid to commit. He didn't take responsibility. He never said sorry. All of this stuff turns out about his past. And what he learns during this quest, and what he learns when they finally get to the star, is that he doesn't need his additional 9 lives. What he needs just is to commit to this life, to take responsibility for his own life, and to team up with a female cat and live happily ever after. And really take responsibility for his life, and that he doesn't need 9 lives in order to live his best life, if you will. All right. And Goldilocks discovers that she doesn't need a human family. Her family of bears is fine and amazing. And the kid with the thumb, or the adult with the thumb who's evil, he dies and disappears and is no longer evil anymore. He's Little Jack Horner, thank you, Jennifer. Little Jack Horner, who's not little at all, he's massive, basically dies at the end. So it kind of has a positive theme in the sense that Puss in Boots learns to appreciate life, the one life he has. He learns to commit. He learns to stand by his obligations, to take responsibility, and to make the most of the life that he has. All that is good, consistent with Yaron's rules for life, right? I still didn't like the movie. And I didn't like it for a number of reasons. I didn't think it was particularly funny. I didn't think it was that entertaining. It had a good theme, generally. But it kind of didn't in the end, right? Because does Puss in Boots go back to being a hero? Does he get his old panache back? I'm not convinced. It seems like he loses it during the movie. It comes back in a flash where he fights off death. But does that mean now he's going off with the lady cats and he's going to go back to being the adventurous, heroic, funny, cocky, self-confident Puss in Boots? I don't know. Is the movie suggesting that in order to take responsibility, you have to stop being so fun-loving and positive? I don't know. It's not clear. But mostly I just found it, and maybe it's just, it's animated and it's silly and it's got, the humor is, I think, kind of silly. It just wasn't that funny and it wasn't that entertaining and it wasn't that interesting at the end. The dialogue was okay. A lot of people thought this movie was amazing. It gets very high ratings generally. I guess not that high. It's 7.9 out of 10 on IMDb ratings. I don't know what some of the others. Critics, I get a meta score for critics of 73. So I just thought it lacked something. And primarily what it lacked is that, I don't know if you know Puss in Boots from Shrek, just that energy and that positivism and that heroism and that not caring about anything. I missed that. 3/4 of the movie, that Puss in Boots wasn't there. And it made it a lot less interesting and a lot less fun when he wasn't there. Okay, so that's Puss in Boots. I don't think the love triumphs in the end. It just wasn't. The whole thing is not convincing, and it's not convincing that he changes. It's not convincing that he got it. The different challenges are not that interesting that he has to face on the way. And again, it's not as funny as I think other Puss in Boots and entertaining as other Puss in Boots kind of chapters have been in the history of the franchise. All right, we had two songs. Let me start with Shazbot's Hot for Teacher by Van Halen. I guess I just don't get it. I don't find the song particularly good, particularly interesting. Van Halen can be interesting. I'm not a huge Van Halen fan, but sometimes the riffs on the guitar and sometimes the beat and the rhythm and the melodies are exciting and thrilling and you really get caught up in them. I found this a little boring. It's about, I guess, I try to read the lyrics, but the lyrics about, having a hot teacher and what you think about having a hot teacher and kind of sexual innuendos about, I can't even say the word, about the hot teacher. I saw the video with the song. I just not impressed. Again, the music is not that great. The lyrics are okay, but they're just not that interesting. Yes, there's a girl dancing on the stage with a bikini. Woohoo. I mean, you can see that in every beer commercial. So it's not particularly sexy. It's this dorky kid who's trying to fit in and something with the teacher, some relationship is developing. Maybe he's hoping, he's believing, he's fantasizing, whatever. Just not interesting, boring, primarily. So, yeah, sorry, Shazbot, didn't like that song by Van Halen. All right, the other one was an interesting one. So Doug asked me to review Sound of Silence by Simon and Garfunkel. And I said a few things about it, and he said, you know what? What I really want you to do is compare the Simon and Garfunkel version with the disturbed version of Sound of Silence. Now, I'd never heard the disturbed version of Sound of Silence, so I went and listened to it. And it's pretty amazing. It's pretty amazing to compare and contrast between the two versions. And first of all, you have to realize that The Sound of Music is a very dark song. It's a song about alienation. It's a song about silence. It's a song about teenage alienation, young person alienation. It's a song about not having the courage to speak up. It's a song about not being able to effectively communicate with other people. It's a song critical of the culture, right? And the people bowed and prayed to the neon god they made, and the sign flashed out its warning in the words that it was forming. And the side said, the words of the prophet are written on the subway walls, the tenement halls, and whispered in the sound of silence. And silence, of course, is no communication. Silence is the opposite of communicating. Silence is, in a sense, death. Silence is the lack of communication, the lack of connection between people. So it's a very dark song. And here's the difference between Simon and Garfunkel interpretation and the disturbed interpretation. And it's worth listening to the disturbed interpretation, because it's really fascinating to see the difference in how it affects the song. Right? Simon and Garfunkel sing it in beautiful, calm, unemotional harmony. It's got this beautiful melody. And the emphasis, so there's the contrast between these alienating, cold words, this dark world of lack of communication, of silence, and this beautiful music and beautiful harmony that is sung in kind of just to emphasize the beauty of it. And it's just amazing. By the way, it's interesting history about this song. I'll just tell you quickly. This is Simon and Garfunkel's first hit. Paul Simon wrote this when he was 21. It fit his mood. He was felt alienated. He had read all the dark novels you read as a 21-year-old in college. He read this when he was a college student. He wrote it in a dark room, and it, of course, the opening lines of the songs are "Hello, darkness, my old friend. I've come to talk to you again," and so the power of the words, the power of the emotion of it comes across in some way because of the contrast between the words and the way they sing it. Oh, so he wrote this song. It was on their first album. It basically flopped. It was an acoustic version, just with a guitar, Paul Simon on the guitar, and the voices of Simon and Garfunkel. Now, I think it's a beautiful version, but it was a complete flop. Their producer took the song, they broke up and they went their own ways. The producer then took the song, re-recorded it with background music, right, with a band, and re-released it. It became the #1 song in the country. Hit the charts and went right to #1, which caused Simon and Garfunkel to get back together and record all the albums that you hopefully know of theirs that came later, some of the best music written in the 60s and 70s, just beautiful, beautiful, beautiful music. And it's this song that made them. So what you get is, against this contrast of beauty, harmony, with alienation, darkness, coldness. And I think that contrast works. It gives it a haunting kind of sense. What do they mean, the sound of silence? They're singing. And it causes you to really think and try to interpret it, because their voices are not giving you the theme of the song. The way they're singing it is not conveying the message of the song. You have to get it from the words. You're not going to get it from anything else. By the way, we're still way short. Thank you, John Mirth and the Rio Meatball, because you guys have just put $150 together, but we're still way short of the goal. So I'm hoping I'm hoping that the 60-something people who are here right now can participate and help out and get us closer to the goal. Probably won't make the goal tonight. That's fine. Obviously, not a popular show for live listeners, so we don't have the numbers. But hopefully, we can get a little closer to the goal that we have set. Disturbed's version of this song is really interesting. Because Disturbed, I don't know this guy, this is the first song I've heard of his. He sings the song in a way that through his singing is in a sense conveying some of the message. He sings this song angry. It's rough. He doesn't have the beautiful voices, the beautiful harmony of a Simon and Garfunkel. He sings it alone, looking straight into the camera on video, with this gruff voice. And as the song progresses, he's getting angrier and angrier and angrier. So his version of the song is, I'm angry at this. Simon and Garfunkel's version of the song is, I'm bewildered by this. I'm alienated by the world. You guys figure this out. Figure out what this means. Disturbed is hitting you on the head with the meaning, and he's angry with it. He's disturbed by it. Now, I think it's a powerful version. I by far prefer Simon & Garfunkel because it's beautiful, and I want my music to be beautiful. But I get why somebody would like the Disturbed version because it's authentic in the sense that the singing and the words integrate. They cause you less to think because he's doing the thinking for you. He's doing the explaining for you. So powerful. I thought it was a powerful interpretation. All right, I fulfilled my obligations. I still owe a novella. I still have to read the novella. If I owe anything else, please remind me. That as far as I know, the only thing I'm short on in terms of reviews is the novella. Otherwise, I'm all caught up. But please feel free to ask me to review movies, $500. TV shows, an episode, $250. I haven't seen Oppenheimer yet, maybe this weekend. Songs for $100. And miscellaneous other stuff, we can negotiate a price. So remind me if I still owe you a review and haven't reviewed it. I haven't seen Oppenheimer. I promise to give you a review whether you pay me or not of Oppenheimer once I see it. I'm hoping to go to the theater this weekend and see it. Okay. I have to just arrange my schedule in a way that makes that work. All right, let's go over to the super chat and take questions. Thank you, Real Meatball, who's contributed another $50. That was slowly chipping away, but it was still less than half of what we need in order to get to our goal. Simon and Garfunkel. Somebody says, I love Simon and Garfunkel too. Jupiter Mena says they saw them in 83. I saw them in 83 as well. They came to Israel. And I went with my wife. I think she was already my wife when we went. And we saw them in a football stadium, soccer stadium. And it was amazing. It was, I love their music. I think they're one of the best groups in popular music ever. I think their music is fantastic. And I saw their concert live in Tel Aviv, in Ramat Gan, I think it was 1983, maybe 84, but I think 83. All right. It was one of their reunion concerts. The real Mr. Meatball. When it comes to scaling a business, private equity purchases, does the ability to scale come from the PE firm's know-how about establishing processes and documentation? The scaling comes from two things. Certainly, one thing private equity does is it has knowledge. It knows how to get stuff done. It knows how to run a business. But also, it knows people who know stuff. So it is super well connected. It usually brings in a new maybe chief financial officer, a new CEO, a new other managerial. So it brings in managerial talent. But it also knows how to run a business from a financial perspective. from a business process perspective, as you said, from a processes, it knows how to streamline, make more efficient, make more productive, because they've done it in other businesses. And if they don't know in this particular industry, they hire experts to come in and help them. Because that's the only way they're going to make money, is that they make the business better. If the business is the same, then they gain nothing because they bought it, they paid fair value for it. They can't make money off of selling the same stuff that they bought. When they sell it, they have to sell something better, something more profitable, something more productive. So that's one way they scale the business. Expertise. The second way they scale the business is capital. They bring in fresh capital. That allows for investment, that allows for growth, that allows maybe for more marketing, hiring more sales staff, whatever is actually needed. The capital is there to make it possible for it to grow. Let's see. Real Meatball, another question, $50. Esops, employee stock ownership plans are a huge risk though, because usually they're paid out over time when you're no longer in control. Well, who's in control? So the ESOP is paid over time to the employee. He gets stock as part of his compensation. All it does, it's a risk because A, the stock could go down for no fault of your own. Management could do something stupid and the stock goes down. You could lose your job. You could leave the company and you only get a certain percentage of what is vested. But the purpose is, and I think they serve this purpose well, and there have been studies that have shown this, is to align the interest of employees with management and with owners. If everybody's a shareholder, everybody has the same incentive. Now, not everybody should be the owner at the same level, right? Because some people are more knowledgeable. Some people spend more money on ownership. But giving employees a stake means that, you don't want to give them 51% so they're not running the place, but you want to give them a little bit so at least they have skin in the game. From the point of view of ownership, you want to make sure as a private equity fund that you keep at least 51%, that you keep control. You can't have an ESOP that is so large that you lose control and employees then run. Companies are not democracies. So you've got to keep enough control, enough ownership so that you can maintain control and you can shape the business in the way you want to without asking for employee permission. Right? Thanks, Rio, Mr. Meatball. Okay, one more, Mr. Meatball. It says, long-time listener and just had my first person ever recognize your and Peokoff's book on my shelf. That's cool. That's great. Somebody visiting, and there's the books, and they knew they knew the books. They knew who we were. Thank you. All right, Joe asks, I love the finance topics. Wish I could have listened live to ask questions. Here's a token for the value I'll get listening asynchronously. I appreciate that, Joe. Maybe you can ask a question on a future regular show. You can ask a question about the finance after the fact. And that's true of all of you listening after the fact. If you've got questions, you can just come on a regular show, any show I do live, and ask a finance question, ask a private equity question. I'm happy to answer questions about anything, and this is a great opportunity to do so. All right, we're still quite a bit short, so still looking for another $400, which is a lot. So whatever you guys can do is greatly appreciated. Stickers are great. If everybody does right now, $10, $5, we blow through this. So $5 from everybody will make it. Just think of it as a value for value. You're getting something out of this. Mr. Meatball says, I was recommended doing an ESOP as an exit plan for the company. I think it's dangerous to do an ESOP that owns the entire company. I think that's a very bad idea. I think it's dangerous and not a good idea to do an ESOP to sell the company to the employees and have the employees own it all. I mean, you might benefit because you sold it to them. But you've got to be careful not to lose control and not to give the ESOP, the employee stock ownership plan a majority or control over the company, because then it becomes a zoo. It becomes a disaster. Somebody has to maintain 51%. So usually it's, in a private equity context, it's 10, 20%. It's not going to be more than that. Rue Down says, I love when you go in depth on finance. There's a lot of bad information out there and nobody can properly defend it like you can. Thanks. I'd love to hear your thoughts on Oppenheimer. Yeah, I already have thoughts of an Oppenheimer because I've been reading about the movie. And I've got thoughts about the atomic bomb. But yes, I want to see the movie. I want to see what he actually does with it. And then I'll let you know. Justin says, I'm reading Road to Serfdom and is surprised by the strength of moral arguments for capitalism. What do you think are the most significant differences between Hayek and Rand's ideas on the morality of capitalism? Oh, God. I mean, if you read what Ayn Rand thought of the Road of Serfdom, she thought it was a complete sellout. I mean, he constantly grants credence to the welfare state. He constantly grants credence to regulation. He constantly, gives a bone to the mixed economy. He's constantly compromising and wishy-washy. There parts of the book where he comes across as a defender of capitalism, primarily, though, as a criticism of socialism. But he doesn't get to the heart of what capitalism really is, and he doesn't defend it from an individualist perspective, from the perspective of the individual's right to live his own life based on his own mind, in pursuit of his own values, capitalism being the only system that allows him to do that. There's none of that kind of morality. It's mostly kind of a utilitarian, good for the, society, good for the collective, Adam Smith almost like. And again, there's way too much. I mean, you should see the marginal comments that she writes about by Ayn Rand's book. There's a book, Ayn Rand's Marginalia. And in that book, you can see her commentary on the Road to Serfdom and how critical she was of it, because he sells out on capitalism so often and so much, and I think he grants them the moral high ground. So I'm not sure where you're seeing a strong moral argument. I don't remember seeing a strong moral argument in the Road to Serfdom. I remember being appalled at the amount of compromising he does. Michael says, thank you, Shazbot. Appreciate the support. Again, if everybody does what Shazbot just did, which is $10, everybody listening right now, we blow through the number. You don't have to ask a question. He just did a sticker. You can do a sticker. Just put a sticker up there. Of course, if you want me to review a movie, a song, a TV episode of a TV show, feel free. Michael says, do you think people who only buy real estate have nothing in the stock market are foolish? Yeah, generally, I think diversification is good. I think some real estate is good, but you want to have some stocks, you want to have some bonds, you want to have some international stocks. You want to have a diversified portfolio. I think such a portfolio does the best over the long run. It has the best kind of long-term risk-adjusted returns. It's the most stable returns, and the best returns are when you actually diversify. So again, risk-adjusted, it's the best way. So don't put all your money in one basket, ever. Justin says, who are your guests for the next few weeks? Tomorrow is Augustina. We're going to talk about immigration, so hopefully you guys will show up for that. You can ask me all the tough questions. You can get all the gotchas on immigration that you want. I don't see anybody booked for the next few weeks. I have to talk to Angela, my assistant, about booking people for the next few weeks, because I have nothing. Augustina's the only one I have. So we'll work on booking more guests for the following weeks. So I'll be able to let you know in the weeks to come who those guests would be. Okay, Daniel says, Viva Yaron Brook. Thank you, Daniel. Friend Harper says, cheers to the very rare occurrence. I hope it comes back up to those interested. The episode is still up on the podcast. I don't know what you're talking about. Which rare occurrence? Oh, oh, that's right. The one that they took off. Hopefully they'll reinstate it, because it's a shame not to have it on. I mean, I thought it was a great interview. Apollo just says Unromantics by Megan Ribbons. Yes, I know. That's the one I still owe. That's the one review I still owe. It's on my to-do list. I will get to it soon. Promise. Let's see. All right, we're like halfway to the 650. Ooh, Real Meatball just got us further down the road. All right, so let's take Real Meatball's question. Have you considered doing a review of the new podcast like Fresh and Fit, which have steadily growing following? They have become extremely popular and advocate. I'll advise ideas for life for young men. I think it would get some traction. No, I've never heard of this podcast. I didn't know it existed. I will. Let me write that down. Why did I close that file? I'll write it down, and I'll make sure to look at it, check it out, and see if I can have something intelligent to say about it. Hopefully, I can do a show either critiquing it or complimenting it or doing something with it. So, if there's others, Fresh and Fit is one. You said new podcasts and plurals. So if there are other podcasts you think I should review and consider commenting on, let me know. Send me a list of podcasts I should be commenting on. I'd really appreciate that. All right. Real Meatball, Real Mr. Meatball has done his share today. He's done like $200, and that has got us a good way towards the goal. We're still short. So if somebody else wants to match what Mr. Real Meatball has done, we'll make the goal. Pretty much sure we will if somebody matched what he did. All right, Apollo Zeus. This has probably been asked before, but what is the name of the sculpture in the background? That is a David. It's David. That is David. After he's slaughtered Goliath, he's got that foot is placed on Goliath's head, so that thing at the bottom there that's hard to see because it's not really in focus is Goliath's head. He's putting his sword back. The sword doesn't exist. It broke, but you can see the handle of the sword he's holding, and he's putting it back into, what do you call that? He's sheathing the sword. Anyway, he used the sword to cut Goliath's head off, and he's putting it back in the holster. It's a David. It's a 19th century cast. It's a 19th century sculpture, a real 19th century cast. So I love it. I love sculptures from the 19th century, and the ability, you can go online today and buy sculptures from the 19th century that were cast in the 19th century and sculpted in the 19th century for like, a few $1,000s. I mean, it's a real bargain in terms of the quality that you're getting, in terms of the beauty of the sculptures. I think he's gorgeous. He's got like a turban on his head. One of these days I'll put him in focus and you can see him properly. Thanks, Apollo Zeus. Real Meatball is back. Recently had a debate with a self-described communist. Do you think it's better to argue the morality or efficiency of capitalism? Look, I think at the end of the day you have to do both, because both are true. But I think the more important thing is the morality. I think the problem with communism, first and foremost, is the morality of it. And I think you get bogged down on, was it real communism? Was it real? Did capitalism do this? Did capitalism do that? But the most important thing, and the thing that ultimately leads to the practical argument, is the morality. So you have to be able to do both. You have to have enough facts to be able to muster the case for both. But the most important case, and I think the case that can resonate and can be understood by people, because people don't really understand economics, but everybody understands morality, is the case for freedom. It's the case, capitalism is freedom, and making the case that capitalism is freedom. Freedom is a value. Freedom is what promotes human well-being. Freedom is what you need as an individual human being to live a happy, successful life. So the case for freedom is the case that you want to make, and that's a moral case. It's fundamentally a moral case. It's about creating an environment that makes it possible for you to pursue your own values, to pursue your own happiness. It said, is fashion fit part of the manosphere that puts down women? And I mean, I can comment on that in terms of negatively, but you know, dating tips and making fun of women. I mean, it's quite possible they would be popular, and I could do a critique of that, which is fine because I'm critical of that. All right, it's so sad that we don't have a proper perspective of masculinity, a proper perspective on male-female relationships, and a proper perspective on how men and women should treat one another. It's kind of sad. Austin, how would a hero from Ayn Rand's books conduct himself as a tech entrepreneur in today's time? For example, how would he speak to Congress? How would you deal with investors and employees? I mean, I think you would tell Congress to shove it. I think a modern day Ayn Rand hero who succeeded, once he's successful in tech, he's a CEO of a successful tech company, tells Congress to butt out, to let him produce the wealth, to let him change the world, to get out of his way, to stop placing their feeble minds before his, and to go and get a job, something like that. I think he treats his employees well as partners on a goal of making money. He doesn't have a DEI program. He lets the employees who don't like that leave. The company itself, he keeps it neutral from politics. Business is not politics. Business is about maximizing, making, creating, building, creating values. Focus on that single-mindedly, telling investors that's what he's doing, and telling Congress to get out of his way. That's it. Doesn't have to get into political debates, doesn't have to have an opinion about trans, doesn't have to have an opinion about the war in Ukraine, doesn't have an opinion about anything except get out of my way. Don't butt in. Don't interfere. That's what he needs, right? And that's all he needs. And I think somebody like that could really have an impact. Imagine a more rational Elon Musk, a more consistent Elon Musk. The fist, in the waving your fist to the sky is what regulators are supposed to do to his satellite company. And, telling the regulators to come and shut down his company during COVID. I mean, if that Elon Musk took those ideas consistently and applied them consistently and took Ayn Rand more consistently, wow, I mean, it would be pretty magnificent. That's what it would look like. Andrew says, I don't think it's essential because you're radical that you're not more popular. It's also that you teach real topics. Is that what interests the masses? They really only gravitate to tribal warfare. What do you think? Well, I don't know. I mean, look, there are podcasters out there that do finance. They do finance in depth and have mass followings. Certainly bigger than mine. I mean, they have hundreds of thousands of people following them. There are people like, Lex Friedman, who do thoughtful interviews of scientists and thinkers and, really take on challenging topics and long format. And they have massive audiences. So I think, finance is a niche. And if I just did finance and if I had something unique to say and I was entertaining, and then, yeah, I think you could build a much bigger audience. I think it's the fact that I touch on so many different topics that there is no one audience for it. So like this morning's audience that wanted to listen to the news is not necessarily the same audience that wants to hear about private equity, which is not necessarily the same audience that wants to hear about the new rights or this kind of cons or that kind of cons. And then people are just pissed off by me, right? Because on the issues that are tribal, I don't fit into any tribe. So this tribe is not going to join and that tribe is not going to join. And they might be here for a while and then they hear me say something that goes against their tribal thinking or going against what they think and I'm not convincing enough. And they go off, they leave. So I don't fill an easy niche. Who are my listeners? People interested in what? Private equity? No. Finance? No. Philosophy? No, I'm not really a philosophy podcast. Current events? Somewhat, but only if you're interested in a particular point of view in current events. If you're interested in your tribal view, if you're interested in left or right, then you're not going to listen to me. If you love Trump, you're not going to listen to me. If you like Biden, you're not going to listen to me. So it's not clear who the audience is. It's not clear who the audience is. I know a lot of objectivists who are just not interested in current events, so they don't listen. Some people, there's a lot of reasons why people don't listen or I don't have a lot of subscribers. But at the core of it is I can't build a mass audience because I'm too radical and my topics are too diverse and I'm too non-conventional in pretty much every one of those topics. I don't fit easily into people's tribal or whatever niche. I don't have a niche. The niche is people interested in Ayn Rand and in current events and in my perspective on things. I don't know. You tell me what the niche is. You guys belong to it. So, but I'm always going to lose people. In the 2000s, I lost people after 9/11 because my views on 9/11, I wasn't a conspiracy theorist, and my views on how to deal with them, on war and everything else. I lose people on Trump. I lose people on abortion. Every one of these on religion. I mean, you should see what how people go after me on things like American exceptionalism or on showing American exceptionalism because I was so emphasized the secular nature, or on new right, on attacking the new right, or on attacking any one of these. It's kind of entertaining. The war in Ukraine. Oh my God! Did you see on Twitter the Libertarian Party of New Hampshire really was upset by my talk on Ukraine. I'm not even sure they heard it, but the fact that I would dare to be pro-Ukraine and against Russia, they just flipped out. And it wasn't like, I can kind of understand people saying, look, it's not America's interest, why are we spending so much money? I think that's all wrong. But I think it shows, anyway, but I can kind of understand that attitude. But the attitude of, oh no, Ukraine's just as evil as Russia, there's no reason you could have Russia's defending the West and we're pro-Russia and all. That's just insane. And much of the Libertarian Party is there. I lost a huge number of libertarians on Twitter yesterday because they suddenly discovered the talk I gave at Ocon on the Ukraine war, and they freaked out. And I'm a warmonger. I'm a neocon. I'm just the worst human being alive. So, there's no issue in which I don't make enemies. And there's no, how you show these circles of overlap. Where is the sweet spot where everybody overlaps on the issues? My overlapping group is small. And the number of people in the other groups who don't agree with me or willing to listen to me is small. It's just the reality. I don't know. Maybe one day there'll be some issue, some topic that'll generate a real uptick. I thought in the past that I'd hit on certain topics where the trajectory was all up, but then it doesn't sustain itself. So, Proto said, just keep putting out content consistently and it will take off. But the reality is that I've been putting out content since 2015. Now, I'm not going to stop because I enjoy this and you guys are here and I value it, and you guys obviously value me, and we raise significant amounts of money, and I can't quite make a living out of it, but I can almost make a living from this show. So I'll keep doing it. But the reality is that I've been doing this in one way or another since 2015, And it's grown, and it still grows, but it's flattening out, and it's not growing as fast. So I don't know. Suddenly it's going to take off. From where are these people going to come? And it's not like people don't know who I am. People do know who I am. I mean, lots of people out there know who I am. I've got debated people. I've been on clips. I've been on... some of my videos have gone viral to millions and millions of people. And yet very few subscribers. So what it takes to make it take off, what it takes to project me into the 6-figure subscriber universe, I just don't know. But I agree with you that I just have to keep on producing content. There's no other choice. That's all I know how to do. Maybe it's better marketing. Maybe there will be a time where some of the topics I care about and have something really interesting to say, and where people will come over. Obviously, some people, real Mr. Meatball, and others, whether you align with my views or not, find it interesting enough to come to the show and support it. I've got hundreds of people who financially support the show. So the number of people who support the show relative to the number of subscribers, I think, is relatively high. But the amount of money I generate, the amount of income I generate from the show is relatively high given the number of subscribers. So the people who do support the show are pretty passionate about it. And that's pretty amazing. All right, let's see. Yeah, Daniel Rules. Your oldest video is 6 years old on YouTube. Have you done a show before YouTube? I know you did many talks in the past. What inspired you to begin your YouTube channel? Yeah, I mean, I did before YouTube. I did podcast radio, so it was just audio. And I think it was Amy Peokoff who inspired me to do YouTube. She suddenly inspired, no, Amy inspired me to do podcast, the radio thing. Maybe she inspired me to do YouTube as well. But basically, technology got to the point where it was really easy to do the show on YouTube. And I used to have a lot of people who watch the show on Facebook. Now, very few people watch it on Facebook. I think partially because the Facebook algorithm doesn't really help me in any way. It really suppresses the show for whatever reason. So I get very little views on Facebook. It used to be I got a lot of views on Facebook, thousands. Now I get almost everything on YouTube and the podcast. The podcast still going. So it used to be audio only. And then as I was doing them, I realized, hey, I could go video. And I started doing them video and audio. And I've continued doing that. So what's it been? 6 years for video now. And again, the technology got cool. I remember, what's his name? Somebody bought me a camera and encouraged me to do it. So just multiple steps to get it, to get there. Daniel says, in some weird way, I selfishly want your audience small. You are my favorite educator podcaster. If you got too big, you would feel farther away, like the local band that got too big. No, because I'd still be in the same place with the same relationship with you. And because you were there for all those years where I had a smaller following, you'd be special. You'd be one of those people who've been there. You remember those first shows I did. You remember the shows I did during COVID or whatever, whenever you joined, right? It would be more special. You'll be able to say, that guy, he's my guy. And look how big he is today. So no, I'm not going to be further away from you guys when I'm big. Shows will have to be longer because we'll have more super chat questions. There'll be more participants. There'll be more people watching live. Finn Harper says, I'm 150 episodes away from listening to all the podcast episodes. I'm in June 2020 right now. Haha. 3 months after I got into Objectivism. Cheers. I wonder if you've got all the episodes, because some of them are on Blog Talk Radio and not on the podcast network that you're probably on. So the first show I did, just so you know, first show I did was January 2015. January 2015. So you could go way back. You could go way back. Apollo Zeus asks, how is doing a radio style format different than YouTube? It's very similar. Just YouTube is more of a hassle in the sense that you have to deal with video. You have to get lighting. You have to make sure you've got the right camera. You've got to look okay. You've got to, be, in a radio show, you can just be sitting back. Nobody's looking at you, and you don't have to have all the equipment. But the other thing I had when I did Blog Talk Radio is I used to take calls. So I used to take calls. There was a interface which allowed me in the podcast to get phone calls, and that was fun, and that was kind of interesting. And so I kind of missed that. That again, I like the immediacy of doing something live. Remember, I also did radio. I was on Blaze, on the Blaze network on radio. I did radio in Chicago. I did radio in Chicago. Both of those failed primarily because I was anti-Trump. And this is in the first few years of the Trump administration. And me attacking Trump did not go well. Not the Blaze audience didn't want to hear it. They were not interested. So I had a big audience, but it didn't grow. It didn't grow. It stayed steady and constant. Because the people who were willing to listened, and everybody else turned it off because they weren't interested in me criticizing Trump, criticizing religion, criticizing the American right. No, I mean, I missed my calling. I should have just been a standard attacker of the left, and then I would have gotten a much bigger audience. It wouldn't have been me, though. Justin said, I already answered that. Proper, this is the last question. If anybody wants to chip in, we're only 182 short of the goal. We've made up a lot of the deficit. I thought we'd be in much worse shape. We got 60 people, $180, $3 a person, and we're there. Proper says, whoops, when I was in college in a small college town, I had a part-time tech internship. The company got bought out and I lost my job. But the stock I held went up 6x and ended up paying for my tuition. Yeah, I mean, that's the beauty of a dynamic economy where you allow for these transitions, for buying and selling, for people to buy you out, for different forms of compensation, like stock compensation. That is really the beauty of that kind of economy, that you can walk away from a deal like that, lose your job, and still make money because you got stock. Capitalism is a beautiful thing. Markets are a beautiful thing. All right. We've gone almost 2 hours. Thanks, everybody. I hope you got something of value out of discussing private equity. I know it's more of a technical field than it is a philosophical or broad field, but I do think it's important to freedom and to liberty to defend financiers. You know that. I've written a book about it. They're attacked unjustly, and private equity is the latest among many of the financiers to be attacked over the generations. And what they do is incredibly productive. What they do is incredibly important. What they do is incredibly wealth creating. Have a great night, everybody. I will see you all tomorrow morning. And tomorrow night, we'll have